$500, one trade, one night, and an account balance of 0 by morning. Not a scam, not a hack. Just a trader who skipped 4 ideas he didn't know he needed. We're rebuilding his trade from scratch, piece by piece, right now. Meet Marcus. $500 in his account, first real trade. He reads that the European economy is slowing, so he shorts Eurodollar, and he shorts it big, way past what $500 should ever control. Rates move against him overnight, no stop, high leverage, one swap charge stacked on another. By morning, the account reads 0. The broker doesn't call it bad luck, it calls it a margin call. Everything that wiped Marcus out, the size of his position, the leverage behind it, the overnight charge that kept eating his balance, all of it traces back to 5 ideas we're about to unpack, starting with the one Marcus skipped entirely, why he was even selling Eurodollar in the first place. Marcus sold Eurodollar because a headline said the European economy is slowing, but slowing compared to what? Fundamental analysis is simply comparing the health of one economy against another using a handful of scoreboards. How productive the workforce is, how many people have jobs, how busy the factories are, whether the country sells more abroad than it buys, and where interest rates sit. Line up those 5 numbers for the Eurozone against the same 5 for the United States, and you get a lean, not a guess, a lean toward one currency being stronger. That lean is what turns into a buy order or a sell order. Marcus had the lean half right. He never checked if the other side of the pair, the dollar, was strong for the exact same reasons. And that gap is where his trade started to go wrong. Every pair in Forex has an order, and the first currency listed is called the base currency. In Eurodollar, euro is the base, the dollar is the quote. Your view on the base currency is what decides your order. Think the Eurozone economy is strengthening against the dollar? You buy Eurodollar. Think it's weakening, like Marcus did. You sell. On direction alone, Marcus was actually fine, bearish view on the base, sell order. That part of his thinking lines up. But direction was never what killed his account. It was the size of the sell. He didn't place one currency unit of risk. He placed a lot. And most new traders have no idea what a lot even means until it's too late. Forex isn't traded $1 or €1 at a time. That would take forever to move the needle. It's traded in standardized blocks called lots. A standard lot is 100,000 units of the base currency. A mini lot is 10,000. A micro lot is 1,000 units, and that's usually where beginners should start. Marcus, with $500, didn't open a micro lot. He opened a standard lot, 100,000 euros of exposure, because his platform let him. Nobody stopped him, because technically, he could afford to. Not with his own money, though. With $500, there's only one way to control 100,000 units of currency, and that's the part of the story we haven't touched yet, borrowed size. This is where leverage comes in. A broker offering 50-to-1 leverage means for every $1 of your own money, you can control $50 of position. Flip that ratio, and it's called margin, the deposit the broker actually holds against your trade. Pause for a second and guess. To control one standard lot, 100,000 units, at 50-to-1 leverage, how much margin does that require? It's $2,000. Marcus had 500, so his platform must have offered leverage far higher than 50-to-1. Some go up to 200 or even 500-to-1, which is exactly how $500 ever touched a standard lot. Leverage itself isn't the villain. It's a tool. But that size, in inexperienced hands, changes what one bad day can cost you. Here's the number that should sting. At 50-to-1 leverage, a move of just 2% against Marcus's position doesn't cost him 2%. It costs his entire $2,000 margin, 4 times what he actually had. His account was mathematically headed to 0 before the euro even moved that far, because leverage multiplies both directions equally. Profits grow. Losses grow just as fast, only nobody feels that until the margin call notice appears. This is why professionals treat leverage like a loaded tool, not a shortcut. And the part that actually saves an account from this exact scenario, the stop, the sizing, the discipline, is coming right after we check where Marcus should have looked first, a real, live chart. Let's do what Marcus never did, read the actual chart before pulling the trigger. This is a live Eurodollar chart, real candles, right now. Fundamental bias doesn't live in a single candle. It lives in context. Where price sits relative to recent highs, recent lows, and the overall trend the economic story has been building for weeks. That matters more than any single candle shape ever will. Pause the video right here. Look at where price currently sits on this chart and guess. Does the recent structure support a bullish lean, a bearish lean, or neutral before economic data even confirms it? Whichever way you leaned, the method is the same every time. Compare the macro story to where price already is, and only then decide buy or sell. Marcus had the story. He never checked the chart. Here's the charge Marcus never saw coming. Because it doesn't show up until you hold overnight. Every position in Forex is really two loans stacked together. You're borrowing one currency to buy the other. Hold that position past 5 p.m. New York time, and the broker settles the difference in interest between the two currencies. That's called rollover, or swap. If the currency you're long pays a higher rate than the one you're short, you earn a small credit each night. Get it backwards, like Marcus did, and you pay a small debit every single night the trade stays open. One night, it's pocket change. Stack it across a losing position that's already bleeding from leverage, and it becomes one more drip pulling the account towards zero. But the size of that charge isn't random, it's set by one thing. Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.